Welcome everyone. Thank you for joining us. My name is Mahima Lal and I'm a part of engagement marketing team at Hero Vired. I am your host for today. So before we begin with the webinar, I'll start by telling you a little bit about Hero Vired. So Hero Vired is a virtual education company which is the part of the Hero Group. Hero Wired is on a mission to not only reimagine the way we learn, but also build a better and a brighter future. So, we are here to equip our learners with knowledge, skills, expertise they need in order to find success. So, today we are presenting a webinar on the topic Business Valuation. What is a business worth? By our speaker Lalit M. Fulara. So, I'll be introducing everyone to Lalit. So, Lalit is a CFA and LLB with an experience of over 13 plus years. He is a CFA charter holder and has worked on projects across assurance, business advisory, anti-money laundering, and transaction advisory. Lalit is currently working as a faculty in finance at Hero Vired. Welcome, Lalit. With Lalit, we
Thank you.
have Mohit Agarwal. Mohit is a part of our career services team at Hero Wire. He will be helping us out in order to know more about the placement related queries. Moving forward, we will be going through a quick poll, which you all will be seeing on your screen. So, where you need to provide us with basic details about yourself. So, I'm quickly running a poll. You can go to your screens and just poll there. Also, if you have any questions during the webinar, please make sure that you're typing your question. So without any further ado, I would like to hand over this webinar to Lalit.
Thank you, Mahima, and thank you for getting us started, and thank you all the participants, all the attendees for taking out time to do this. As Mahima already informed you about my background, I'm a finance and law guy, working in industry for almost 15 years now. Did my work here and there across countries, across continents. Worked with EY for a very long time before jumping into education. So there are two things I want to talk to you about. One is, of course, who we are as a choice in terms of financial knowledge or any upskilling that you want to do in finance. And then I have planned a little exercise in valuation for you guys, which I'll expect all of you will participate in. So there'll be questions that I'll be throwing your way, and there'll be opinions I'll be taking, which you can share through the chat box. Okay. And we'll try to see what are the various approaches, or at least see hands-on one of the approaches towards valuation and how exactly that falls in the bigger picture. So the idea is, guys, whenever we think of finance, whenever we talk about finance, we automatically think of money, and rightly so, right? Finance in simplest of terms is whatever happens to money after it is issued, right? It could be borrowed, it could be invested, it could be put to a number of uses, right? And we also see different markets in within finance. We see equity markets where you are dealing with shares, where you become the owner. We see the fixed income market where you're dealing with bonds and debentures. We have alternate asset markets. Anything which is not a share or a bond is an alternate asset. It could be real estate, it could be gold, or it could be crypto assets these days. So all in all, we try to take our learners through all these markets in details, including derivatives. We learn how to price them, how to value them, how to take a decision around them, what exactly are the kind of skills that we need in order to build a career in finance. And one of the most important skills, which is prevalent or which is applicable everywhere in any market, in any field that you work in finance, is valuation. Right. And as the name suggests, valuation is simply an exercise based on probability, based on logic, based on existing data, based on forecasted trends, based on expectations about the future. We try to say that, okay, this particular asset, and an asset is anything which could generate cash flows for you. It could be a share, which gives you dividend. It could be a bond, which gives you interest. It could be investment in a company, in a restaurant for that matter, which gives you some money every year or every 6 months, right? So valuation is one such exercise which is applicable everywhere, which finds relevance everywhere. And what we're going to do today is look at one of the approaches towards valuation, including financial forecasting the future. How would my business would look like in the future in terms of profitabilities, in terms of how exactly cash flows will be generated, and based on the risk involved, what it is worth as of today, right? So here I have a very simple exercise in front of you. This will be a very hands-on thing that we'll do together. And what I have here is the opening balance sheet and the year one income statement and cash flows related to a poultry farm. Why we are taking this example? Because valuation occurs, or the exercise called valuation should not be seen as a static activity, but a spectrum, right? So let me ask you this. If there is a company which is trying to get into a business of delivery of Amazon and Flipkart products using drones, and we need to find out its valuation as on a given date as of today, how exactly we can go about that? Any thoughts are welcome. There are no incorrect answers as of now. So there is this company which will be using drones to deliver small packages. How do we go about its valuation? You can type in your answers. I'll be able to see that in the chat box. Anyone, any thoughts? There are no wrong answers here. Discounted cash flow method, Pradeep says, yes, one of the most prominent or one of the most frequently applied method is a discounted cash flow method. That means you're first predicting the future, how much cash it will make for you in the future. And then you say, okay, 100 rupees after 1 year is equal to 90 rupees today or 80 rupees today, depending on the risk. Higher the risk, lower is its value. What I'm trying to say is, if I write you a check right now for 100 rupees, and you can go to the bank and get cash out of it after 1 year, will you be willing to pay me 100 today to get 100 after 1 year? The check gives you 100. Let's say for sure you get 100 out of this check after 1 year. Will you be willing to pay 100 for it? No, right? You'll be willing to pay something lesser than that. How much lesser? That will depend on the riskiness involved. How much you trust that, whether you'll be able to get money out of it or not, right? Higher the risk, lower is the value you are willing to pay for it. And that is what Pradeep refers to as discounted cash flow method, right? You have cash flows and you discount them back to the present, right? So as I said, valuation would exist in a spectrum, right? It's a range of activities or a range of logic or tools that you deploy. On one hand, we have mature and stable businesses, a car aggregation business or a cab aggregation business for that matter, a car garage, a body shop for that matter, a soap factory for that matter, paper manufacturing unit for that matter, a poultry farm, example which we'll take today for that matter. Things have stabilized. The ratios of cost to revenues and so on and so forth, they are almost stable, right? On the other extreme lies your novel businesses, where it's very difficult to come up with a starting point. Now, Pradeep said that in order to value a business which will do what, which will be a logistic services basically, but instead of human beings, it will use drones, right? It is very difficult to utilize discounted cash flow. It is very difficult to first predict how much cash flows you will generate in year 1, 2, 3, 4, and so on and so forth. And then to predict the same, it's a different difficult endeavor. So please understand that there are more than one methodologies which we deploy for evaluation. There are at least 3 methods, and I'm gonna write it down here. One is, of course, the discounted cash flows. The second is comparable valuation. And third is asset-based approach. Now, whenever you try to value something, you can't just rely on one method. Why? Because the probability that something will be wrong, something will be off is a real possibility. So what you do is you try to triangulate and try to approach your valuation exercise using at least 3 methodologies. There could be more than that. One is discounted cash flows, but the point is applicable only with slightly stable cash flows, where you know that, okay, I'm out of the research phase, I'm out of the initial nascent stage. Now the business will run into profitability and will generate some cash flows. Second is, this could be applied anywhere as long as you have a precedent. What do I mean? So let's say there's this soap manufacturing company. It was sold, let's say, very simple example, it was sold at 20 times its revenues. Let's say sold at 20 times of last revenue. So that's a starting point. Now your company also manufactures soap and is more or less the same than the company that was sold earlier. Given your revenue is 1 million, you would also ask for $20 million. And of course, we'll adjust these numbers. We'll see how different or how similar the last transaction was, right? That's another way. And the third way is sell everything, every asset, pay back liabilities. Whatever is left is the value of equity of that organization. So all the equity or all the shares concerned after the liabilities are paid, that is the value of the equity. Now, this is one of the things that we do in the programs that we offer, which is the valuation of businesses, right? Learn the art and the science of. Yes, Rohit, I'll come to that. There'll be a slight discussion after I'm done with this particular example. So the first thing that I'm going to do is I'm going to focus on this here. So let's say that you have some cash, you have some spare cash, and you want to invest it, you want to create a second stream of revenue for you, right? And you want to invest it in a poultry farm. Let's say you came across an article that egg consumption is still increasing in India, and per capita egg consumption could increase in the future, or whatever reasons. I'm not talking about that right now. You came across this business and you were able to borrow the financials from a business, from another business who is doing the same thing, and you have certain insights in place in terms of what they did. So they started with, all these numbers are in thousands. So they started with 1 million rupees or 10 lakh rupees. They bought livestock, which is your poultry, which is going to lay eggs, which you're going to sell, worth 650,000. They made an apparatus worth 200,000 to keep that poultry alive, right? To feed it, to store it, and so on and so forth. They kept another inventory worth 100,000 to feed the livestock, the seed, the feed material, the medicines, and so on and so forth. And they kept some cash to take care of the other aspects of business, right? How did they fund it? They funded 50-50 using equity and debt. So someone contributed equity worth 500,000, and someone contributed or someone gave a loan to the firm worth 500,000 at a rate of 10%. That is how much capital you deployed in year zero, or the day you wanted to start this business. This is what the other business did. And using this capital structure and asset base of 1 million rupees, they were able to generate this much. They were able to generate 2 million in revenue. COGS was 25%, and this is expected to remain stable, for a time being. We'll assume that. Gross profit is 1.5 million. Then SG&A is 10% of your, that is the selling general and administrative expense is 10% of your revenue at 200,000. Every year, some of the poultry is dying, right? And some of the apparatus is wearing down, wear and tear is there. So this much is the depreciation for that. This much is the cost that you're charging to the business for losing the livestock and the apparatus that you have maintained or you're maintaining to run this business. That means an operating income, after paying all the operating items, the operating income of 1.2 million, paying interest, you're left with $1.15 million. You paid tax of 20%, you're left with this much of net income. Out of that, 50% was paid out as dividend to the investors, and rest 50% was invested in the or reinvested in the business. This is the information you have, and you have reasons to believe that this industry has stabilized. So the ratio of cost to revenues and few other aspects will remain the same. Yes, we can share this. Yes, we can share this model with the attendees if required. Yes. Now tell me, guys, I want to predict year 2 revenue. Is there any logic? Is there any framework that I can develop in order to predict the year 2 revenue? And don't use the words marketing and sales. This is finance. We are not concerned with what is the marketing saying, how much promises they are making that they'll do this or do that. Simply on the basis of financial trends and logic, what exactly? No. So market, let's not use the word market and sales. This is finance. Of course, there'll be some insights we'll want from our marketing team, from our sales team, but this is finance. Let's rely purely on numbers. What drives the revenue in this business, which is the most important asset for this business. Look at the balance sheet. That means look at all these items, which I'm going to highlight in green, and also look at what it did to the revenue in year one. Livestock, of course, yes, because it's a number of hen that you are carrying or you're holding, which is producing some eggs and which are being sold in the market. So there is this interesting thing, and there's a very simple framework I'm trying to develop. Of course, you look at it again and again and try to use more robust arguments and insights and all of that. But for the time being, I find a direct link between the livestock and the revenue. So 650,000 worth of hen are producing a number of eggs. Some of that is broken, some of that remains unsold. But whatever is sold is worth $2 million. Of course, we would want to create another workbook where we take into consideration all those assumptions. We talk to experts, we'll visit farms, try to collect as much information as possible, try to see if there is some disruption expected in the industry, some kind of artificial feed coming in, which will increase the number of eggs and so on and so forth. But given the scope of this exercise, I'm going to spend like 30-40 minutes with you. So I'll keep those constant. Let's say there is no expectation of any huge disruption in the market or the industry. We can expect this trend to continue. We can expect this trend to continue. That means what? That means given my investment in livestock, that is going to drive my revenues for the further years. Do we all agree on it? Or if there is a counter argument? Apparatus is like where you keep your hen, you feed them water, you give them food, and so on and so forth. Neeraja. That's it. Right. So now here as an investor, because I'm going to be the owner of this, I have to create a certain plan. How exactly I'll run this business. So in year one, as soon as I have this much of revenue, this much of net income, I'm going to do few things. I'm going to increase the size of my livestock. I'm going to increase the size of my livestock. First of all, as I said, out of 650,000 worth of hen or the livestock, 70,000 was lost during the year, as you can see here. So I'm going to buy 70,000 more just to keep my livestock base equal. But I'm going to increase 100,000 as well. So I'm going to put 170,000 more in the livestock to increase it from 650 to 750 on a after considering the depreciation. And all the other items are industry trends. I'm going to maintain the same level of inventory. There'll be some amount of debtors, people who will not pay me directly or right away. I'll collect them from them later, and so on and so forth. So that means the logic that I'm going to use here to get initiated here, yes, livestock will determine the number. That's the assumption here. So can I say this? The revenue next year will go up in the ratio of what I have invested in livestock in the preceding year by the scale of how much revenue was generated last year given a livestock. So this is my estimate, keeping everything else the same. This is my estimate for year two. Oops. I'll unhide these. This is my estimate for revenues for year two. Any comments? You are free to counter argue and say this is not correct, but this is one of the logic. As I said, I'll not just spend 15 minutes on it and say I'm done. Of course, I'll spend a lot of time and resources, collect a lot of intelligence points and incorporate all of that into a model. But what I'm trying to say is, or what I'm trying to show you here rather in a very short time, is the approach which is utilized in real world and the approach that we teach in our programs. One of the things that we teach in our programs, right? So now once I have the idea about the revenue, I can say that I expect the cost of goods sold at the same level, 25% of the revenue. That means this is going to be my gross profit. My SG&A will go up in the same ratio. Selling general and administrative is 10% of what? Of revenues, right? Yes, apparatus will increase as well. We'll have to maintain the apparatus in the same ratio. So how exactly we're going to do that? I have the predicted model already with you guys. So let me run it through you. Everybody is okay with this number. My revenue is going to increase based on how much livestock I have in the preceding year. In year one, I had 650. That gave me a revenue of 2000. In year two, since I have livestock worth 750, my revenue is gonna go up proportionately. Everybody good for that? Okay. My COGS is gonna be 25%. My SG&A 10%. My depreciation is also gonna go up. As I buy more livestock, more hen will die, and I create a bigger apparatus base that will be depreciated. So here I've simply scaled it up, just like I scaled up the revenue. Both the items, the livestock and apparatus, next year 115,000 will be the amount of depreciation. Later, when you get your hands on this model, you can of course go through every number in detail. This will be my operating income. Interest is gonna remain the same. I'm not gonna do anything with my debt. I'll continue to pay interest. This is the earnings before tax. I'll pay tax for 20% of this. I'll be my net revenue, and out of that, half will be paid as dividend and half will be reinvested in the business. That's the second year prediction in terms of income statement, but it is not the income statement items which help me value a business. It is the item of cash flows. So first, let's see in year 1 and 2 how much cash I generated. Again, this is not a session on accounting, so I'll ignore some basics which you can always learn later from me. The cash flows generated during the year were, in the first year, we actually lost 71 of cash, 71,000. Why? I reinvested into the business. I bought poultry and I bought, that means the livestock, and I bought the apparatus. How much? I've combined the two numbers, but you can easily gauge from here. In year 2, in year 1, I have 981 worth of apparatus and livestock, whereas it was 850 in the preceding year. So that means this much I have reinvested in the business, back in the business after depreciation, and depreciation was 100. So you see an additional investment of 231 is made on the investment funds, procuring more assets, newer assets. What happened on the financing front? I paid interest worth 50. I paid dividends worth 460. 510,000 went out of financing activities. What happened on the operating front? The day-to-day activities, I've simply utilized the cash flow generating structure or framework here, adding interest, depreciation, and changes in working capital to say that 670,000 are the cash flow. So that means the business lost a total of 71. And as a result, my cash flows or the cash balance decreased from 50 to minus 21. You can think of it as using overdraft with the bank. There are a few more things that we need to do. We need to be very clear or very much comfortable with the accounting concepts that is in the background here, how exactly cash flows are calculated, how exactly balance sheet is matched, or how exactly income statement is matched. But beyond that is the valuation attempt. Now, one more thing you need to understand, it is not the operating, investing, or financing cash flows that are used to value the business, but these are the free cash flows. What do you mean by free cash flows? Free cash flows are the cash flows that I can dispose the way I want. Out of the cash flows that my business generated, I need to reinvest some amount in capital expenditure, and I need to take care of my working capital, my inventory, my debtors, my creditors, whatever is remaining after that, and could be used to pay anyone, that is either the debt provider or the equity provider, is referred to as my free cash flow to the firm. And the cash amount I can pay only to my equity providers is my free cash flow to the equity. So here is this very simple model which is calculating this for us, and I couldn't go through those details because we are working under a very limited time here. Of course, you need more hours to understand all of it, but I hope the broad idea would be conveyed. These are my estimates of the free cash flows. And how do I know my second year estimate is correct? I know because of two things. First, my balance sheet matches. As you can see, my total assets in year 2 are 2094, and so is my liabilities and equity. So that means my forecast for year 2 is correct in accounting terms. And another check that I have for me is I've calculated free cash flows using three different methods. You see, it gives me the same number, whatever method I use for free cash flows to the firm, for free cash flow to the equity. So that means year 2 forecasting assuming that the assumptions that we have taken stand is correct. And here we have used a very simple technique in finance to project the future, which is see which trend will apply in the future. Here we have relied on a trend that the amount of livestock will determine the number of eggs, which will determine the revenue. Of course, as of now, because this is the foundation of this model, in the first round that I'm going to deal with, I have to account for inflation, I have to account for a few other things, but those are the add-ons that you will make to your. This is the basic. This could be seen as a pizza base on which you will add the cheese and the vegetables and whatnot to create a full-fledged meal. Any questions before I go to year 3 and year 3 to year 10? Any questions here? Anyone wants to challenge my assumptions or calculation? Feel free to do that. And yes, like whose comment is this? Sanket, yes. So you see that I've accounted for the increase in inventory, apparatus. You see apparatus is increasing proportionately every year, and so is the livestock. Another adjustment which I should make here is the change in inventory. When I have more birds to take care of, my inventory should go up. So that adjustment will further make this model robust. And then it's easy peasy from there. Year 3, how much I'm going to increase my capital, my livestock base. I'm going to increase it by 100,000 every year. So my revenue for year 3 will be accordingly scaled up. Rest will behave accordingly, but I cannot assume that in such a simple manner. When I'm actually doing this exercise, ideally in real world, if I'm an M&A guy, so I'll be working on a particular industry. So in few years, I know the industry and I know the trends. I know the cost patterns. I know the disruptions and anything else which is possible. Otherwise, I'll do some research, secondary as well as primary. I'll go visit a farm. I'll go to talk to people who work in the industry, in feed companies, anywhere. I'll try to collect as many insights as possible and then arrive at a conclusion as to how may the future look like using this particular framework. And if I apply it correctly for years 3 to 10, the only assumption that I've taken here or my guiding spirit here is the increase in livestock. You see that my revenues will continue, assuming the market is not saturated, assuming if I increase my production, I can sell it. That's the assumption, of course, here. And I can predict so many other things. When you look into this model, you will know it is correct. Why? Because the balance sheet agrees. That's accounting 101. And the second thing that I know, which tells me that my calculations are robust and correct, are 3 different approaches towards free cash flows. They are giving me the same number, as you can see here. Make the comparisons. Free cash flow to the firm are equal using all 3 methods. Free cash flow to the equity equal using all 3 methods. And once I have it, I am in a position to comment on the valuation of this business. What will we do beyond it? Let's say this is all correct and all the assumptions are correct, and I have operating cash flows, investing cash flows, financing cash flows, as you can see here. These are my operating cash flows. How much are the cash flows being generated out of day-to-day activities? These are my investing cash flows. How much cash is generated or spent on acquiring or disposing assets. And these are my financing cash flows, whatever cash flows I need to take care of my capital structure, paying dividends, paying interest, issuing or buying back new equity, issuing new debt, or paying back the old debt. Yes, that's the foundational, or that's a pivot on which we are proceeding, Sanket. Yes. No, not the cash flows, but the reinvestment in the livestock. As you increase the livestock, so the logic is simple: more hen I have, more eggs I have, more revenue I have, keeping everything else the same. That's the logic, or that's the argument on which we are working. Yes, of course. The second thing, in real world, the depth of your analysis will be based on the size of the assignment. Let's say if somebody paid me 20,000 rupees to do this, do you think I can spend more than 3-4 hours to create this? No, I cannot. Right? But if someone paid me 20 lakh rupees to create the same model, there are more resources and time and people which I can commit. And for every single line item, there'll be so many ways using which I'll arrive at that. All I'm doing in the 30-40 minutes that I have is to give you a broad idea what valuation is about, and using the discounting of free cash flows, how exactly we can arrive at a valuation. Right? Now, tell me, given the operating cash flows, investing cash flows, financing cash flows, as I said, these cash flows are from the day-to-day operating activities by selling eggs. These are the cash flows you generated or you spent on buying and selling assets. And these are the cash flows due to your capital structure, equity and debt, how much you paid to them, how much you generated out of them. And these are the total cash flows. However, valuation requires reliance on free cash flows. Free cash flows to the firm are the cash flows These are the cash flows which could be paid to either the debt providers or the equity providers. This incorporates all the expenditure that needs to be made before that. CapEx has been taken care of. Working capital has been taken care of. So that means in year one, 660,000 is the amount that could have been used to repay the debt provider, extinguish the loan, pay dividends, buy back shares, or whatever else. In year two, year three, and so on and so on. Don't worry about the formula as such right now, because there'll be models and softwares which can do it for you. What is the skill that you need is to how to approach across this spectrum of valuation. This method will apply on a stable business where we can find a relationship, how exactly my revenue will be driven by a certain piece of asset and how exactly my cost will behave. But for a novel business, like I said earlier, if I'm going to start a drone delivery business, this is not the right way to go about it. In that case, I'll try to find some comparable business and some past transactions and accordingly value it. And that means I'll rely more on comparable valuation, that this asset is worth this much because a similar asset is worth that much. You may have heard of that technique being used with real estate, right? Whatever, when you sell a piece, imagine if you remember some piece of land in your lane got sold, the other prices revolve around that. If it was 100,000 per square yard, no one will accept lesser than that. That's comparable valuation. Okay, about it some other day. For the time being, we have cash flows. The only question now is which of the cash flows we are going to utilize, and answer is the free cash flows to value the entire. And what is the technique that I'm going to utilize here is called discounting. Discounting simply means this. I write you a check for 100,000 today. But the point is you can only cash it next year, 12th of November, 2023. Yes, that's comparable valuation, Javed, exactly. Or comparable transaction method that you're talking about. I'll give you a check right now. I write you a check for 100K. Could cash it next year. How much you are willing to pay for it? Let's say I invite a bid who's willing to buy my check. Let's say there'll be no default. You'll get your money for sure. How much you are willing to pay for this check today? Think of it as a financial instrument, which will give you 100,000 next year. Broadly, how much you're willing to pay for this check, which you can only cash next year? Are you willing to pay 100,000? Are you willing to pay more than 100,000 or less than 100,000? You'll pay less than 100,000, and how much less? That will depend on your required rate of return. Let's say, given the risk, you want 10% return out of it. So what you will do is you will rely on something called a present value. And you will simply divide this by a factor of 1 plus the discount rate raised to the power n, and you, on a fair basis, you are willing to pay 90,909. Why? Because if today you invest this money at a rate of 10%, you get 1 lakh after 1 year. That's the idea here. That's a simple math that is happening. If you increase this number to 12, you are willing to pay more. If the riskiness go up, if someone says, no, Lalit is not trustworthy, you increase your required rate of return to 20% and you're willing to pay only 83,333 for it. That's your discounting. Shrikant, I'll invite you to read something called Cost of Capital Survey by EY. I think 2021 survey will be there, not 2022. But just to answer your question, there are three methods. One is called capital asset pricing method, capital asset pricing model. So one is cost of capital survey. We do a survey, market survey, and try to arrive at the same rate. And the third is your bond yield plus risk premium approach. You say how much the company's bond is paying, and then you try to increase it to capture the riskiness of the equity. Not all of that could be discussed within 40 minutes. Okay. Neja, I'm saying there are three methods. One is called the capital asset pricing model to find this discount rate. One is referred to as the survey approach. I asked you to, if you want to, you can refer to the survey conducted by EY in 2021. And third is bond yield plus premium approach. I say that the company's bond is paying me 10%, equity share is riskier, then let's see how much premium I should add to it. But that's not the topic of my discussion. The point is, if I have an investment opportunity and I'm able to predict the cash flows, let's say I have an investment opportunity for 5 years and it'll pay me 20, 30, 40, 30 and 20. Let's keep it very simple. Let's say we have done all the exercises, how exactly we arrived at these cash flows, and this is free cash flows to the firm, let's say. And the rate of return required is 15%. How much you are willing to pay for this business? Let's take this simple example and then apply it to our poultry farm. How much you're willing to pay for this? Assume this is a business or a financial security or anything else for that matter. How much you're willing to pay for it today? One of the method is calculate the present value. Based on what's based on this R. Of course, calculating this R is a big exercise in itself, but that is indeed possible. So what I'll say is I'll receive 20 at the end of the first year at a 15% required rate of return. It's worth only 17.39 as of today. Then the second cash flow, which is 30 at the end of the second year, it's worth only this much. And the price or the fair price I want to pay for it today is 93.47. So as long as this opportunity comes at 93.47 thousand million, whatever that is, it's fairly valued. If you pay more than that, you're overpaying. If you pay less than that, of course, you're fortunate to do that, acquire something which is of greater value. So that means how exactly we go about it? Forecasting based on a particular logic. Then the adjustments of your assumptions based on market intelligence and research. And third is this discount rate. What is the required rate of return? Another approach will help you get there. And finally, when you have everything together, you can actually put it here and say, let's say the discount rate is 25%. I would say this divided by 1 plus 25% raised to the power year in which this is occurring. This much. That means, and as of today, I have to pay how much for this? I have to take out of my pocket this much. I can say the net present value, that means present value of all the cash flows is 4343. So that means this business stands to create a wealth of 4.3 million for me if I can start this with an initial investment of $1 million and all the further or the future cash flows indeed come true. That's one of the ways, but as I said, we never rely on one single methodology. What we do is we try to triangulate. Then I'll see what are the transactions that have taken in this space or taken place in this space. some poultry farms being sold, bought, and so on and so forth. And what is the price paid there in comparison with revenue or comparison with any other measure of income or profitability or cash flows. And I'll take another approach. And third is, if I sell everything, pay back all the liabilities, what will I be left with? And all three approaches, if they are indicating more or less towards the right, same valuation, I'm good. Otherwise, I'll adjust, overhaul my approach and see how much this business is about. Okay, so in 30 minutes, I just wanted to give you a demo of how exactly this could be done. Please, I'm gonna share this with the team. So please allow howsoever this model could be shared. This will be an interesting model to go through, guys. Learn about free cash flows, learn about cash flow statement, how exactly forecasting is done, and if required, if you are interested, you can always always rework on it, change some of the assumptions or something like that. And if you do something crazy on it, feel free to talk to me at this ID. But if you do something really meaningful or add something really meaningful to this model, then I'm really happy to talk you through that as well. Okay, so that will be my 2 cents. I know there are a lot of questions which will be unanswered. Of course, in 30 minutes, not everything is possible. Yeah, let me give you my ID. The idea I'm leaving you with is that what we do in our programs, we take a hands-on approach. Rather than reading or looking at the theory that, oh, this is the way you can do this is the way you can do this, we take real examples, real life examples, and try to build that into an approach which can actually help you do certain things. And valuation and pricing is one of the things you do in finance. You always want to know a piece of share, a piece of debt, a piece of bond, or the company itself, what price you are paying for it is fair or not. And if you do it better than others, of course you are rewarded better than others and you become an authority in this space. Okay, any questions related to this? I'll keep it open for a few minutes. And as I said, our offerings, our financial offerings, or the programs that we offer in finance, they constitute a comprehensive program called Integrated Program in Finance and Financial Technologies, where we learn all about finance, all about valuation, and all about financial technologies, including crypto assets. We have a program called Financial Valuation and Risk Management, Analysis and Risk Management. There also, except for fintech, we learn everything, including a module on valuation. Some good 40 hours, we create a model. Hope you keep that in your drive, and whenever you meet someone, you appear in an interview, you defend your arguments, you defend your position, and try to convert that into the opportunity. There are many mistakes and errors we do in valuation. First thing, if we are assuming that everything will remain stable, that's the worst assumption we can take, Shrikant. It's highly unlikely things will remain the same. This is just the starting of this model. Hereupon, you will continue to add tabs to this model and look at various scenarios and assign a probability to them as to what could happen in the future. That's one mistake, right? Second mistake is assuming that one way or approaching valuation using only one method, that is discounted cash flows or comparables or asset valuation, asset-based valuation, is the correct approach. No, you always have to triangulate, arrive at cover the enemy from three places. Because if your discounted cash flow approach says the valuation is 2 million and your comparable approach says the valuation is 20 million, then there is a problem. If one says 2 million, another says 2.2, it's still fine. It's still fine, right? That's another mistake. Third is, of course, the bias that the professionals bring to the table. If I'm a sell side analyst, I'm a sell side consultant, there'll be a vested interest for me to increase the valuation, whereas a buy side person will try to depress the valuation, right? Every number should have a unique backing. Any number, any assumption, any estimate that goes into the model should be able to answer all the question about it. Eventually, towards the end, how exactly this came into being, this is the reason. If I say that 650,000 worth of livestock will create eggs or produce eggs, which could be sold for 2 million, what is my backing? What is my logical backing? What else? Sanket, I would say, because we are almost running out of time, so personal one-to-one career counseling at this point will be a little difficult for me. And that's the purpose. Why don't you guys share your IDs if you're really interested in knowing about this further, how exactly programs can help you? Please share your IDs and our learning consultants will get back to you and talk to you about that in detail. Because I don't think that I'll be able to do justice to that question in few minutes, Sanket. I'm being moral here, trying not to answer you in like couple minutes and just getting done. Does it make sense? All right. Anything else, guys? Any other question that I may answer in next couple of minutes before I hand it over to Mohit? Thank you. Thank you, Sangeet. Yes, Rohit, go on. Can you also cover how startups can be valued? So as I said, yes, interesting question, Rohit. As I said, valuation occurs in a spectrum. What we see is an example of one extreme where things are stable. We are looking at a mature business which has a long history behind it. So we can get all the estimates and assumptions from there. In a novel business, like I said, how exactly you will value a drone delivery business, right? There is no way, actually no way you can predict the forecast. You can predict the cash flows in there. So what you will rather do there is rely on comparable valuation, but it is also unlikely, highly unlikely that you will find an exact same business which does the same, right? So what you would do is any other business which is there for a while in drone security, drone cameras, wedding में drone are being utilized, you know, survey of hard to reach places, mines, you know, national boundaries, national borders, and all of that. Yes, Sanket. Yes, Sanket. Team, help me here. How do I share this workbook with everyone? Anyhow, yeah. So and I'll just comment on it like very broadly right now. So let's say there is a business which utilizes drone for hard to reach area sampling or surveying, right? And it is sold at a valuation of 20 times, or the investment arrived at a valuation of 20 times to revenue, let's say. So I know that 20 times to revenue is the upper limit for this valuation because my drone delivery business is riskier than the drone survey business. So I'll never pay more than 20 times of the revenue. That's my starting point. And then I'll normalize based on what my intelligence says, what my estimations and analysis says. Now, what exactly startups are doing, what exactly VCs are doing, I'll invite you to read this. Sure. So if you do EY cost of capital survey, I wouldn't get a link because it will get downloaded directly. And feel free to read about the valuation insight. So just do EY cost of capital survey and you will get these items and you can download it there. Sure, sure. So post webinar, you will get your hands on this workbook. To conclude on your question, Rohit, that will be my starting point, comparable valuation. And from there, I'll arrive at a number. Yes, very fair. And I think that's a very interesting question. And that's a skill which can land you in VC firms or a PE firm. Perfect. Right. So I'll conclude here. Yes. I'll conclude here. I think the questions that I could take before jumping on to another sessions are there. You will be given the workbook, of course. And for the career opportunities, I have broadly talked about our offerings, what exactly involves in our program. Ours is a full-fledged program talking about everything and anything that is to know there in finance, to make careers in core finance, trading roles, risk management roles, treasury roles, and also consulting and equity research. Mohit is here with us. Mohit is works with the career services team here at Wired. He's based out of Mumbai, and he will be very happy to talk to you and take you through the career opportunities and also our policies and practices around placements. All right. So I hope last 30-40 minutes there were some thoughts that were provoked. Of course, if you could learn entire valuation in 30 minutes, I mean that will be a great way to go about it. But yeah, you need to spend a bit more time on it. So thank you so much for your time and interest and participation, guys. And over to you now, Mohit. Thank you so much.
I'm Mohit Agarwal, Manager Corporate Relations from the Career Services team. And the if I talk about my role, basically is to have corporate relations, the employee branding, have meaningful relation, strategic relation in terms of understanding what's happening in the industry, what are the skills required, what is the kind of workforce the industry and company is looking out for, and that gets passed on to the faculty, the delivery team, the in terms of maneuvering and you know uh, doing justice with the curriculum that we actually teach to you, and eventually getting some job opportunities basis your skill set that you acquire by taking our program, and also on the current skill set that you have. I see that there were a lot of working professionals here. All right, quickly to tell you about career services at Hero Wired. The career services team is headed by AVP Dr. Ankur Sodhi, sir. He has about 19 plus years of experience in the industry, and he heads um, the career services team at Hero Wired. Now, if we talk about how career services plays an important role in each and every learner of ours, is there are three aspects. First is the career coaching that we do. So we have a personalized career coaching service that we do for our learners. The fact that we want to understand where does our learner stand, what are their aspirations, and what they want to achieve. So career coaches will be assigned to all the learners individually to build their personal brands and professional brand, and along with getting guidance on how to enhance their profile, interviewing, and help them get career clarity. Every learners will be guided by the career coaches every month or fortnightly. That depends on uh, how and how much time do you want to interact with them. Now, post this, we also give them our learners a industry engagement. That is very very important. So, apart from our faculties, which already holds a number of years of work experience working in the industry, those are full-time faculty, and the stars are Lalit Fulara, who you've just heard. There is Shiva, who heads the academics, and there are a lot of other esteemed faculties from the industry who teach our learners. Apart from that, we invite a lot of experienced and senior industry professionals to interact with you and to understand and to let them know what is the reality, what are the expectations of the company, and how you can mold yourself to be a part of this evolving finance industry. So industry engagement happens throughout your journey. The opportunities to engage with both in-house and guest faculty, as I said, who are leading industry experts and have decades of on-ground business experience, will be provided to the learners. The interaction will be enabled through either lectures, through industry sessions, and networking session. Now the place where I am in actually Pune at one of the universities where they are conducting a HR conclave. I was being invited, and through these industry sessions, we build up network, get to know each other, exchange card, exchange numbers, carry on the forward our interaction, and see what is the possibility and opportunity of them to associate with Hero Wired and can be a part of in any which ways. We don't only focus on getting opportunities. That is obviously the primary goal, but there could be a bigger picture in terms of how they can guide us to improve our delivery, our curriculum, the satisfaction of learners each and every, and a lot of other aspects. Apart from, as I said, the personalized career coaching, the industry engagement, there are integrated mini projects that we provide. I'm sure you all are working professionals and you understand that how important the internship and mini projects are, particularly for learners who are looking for a career transition. Either you are a fresher or you're looking for a career transition. Those industry mini projects, those capstone project internship opportunities are very very important, because there are two ways to get a particular role. Either you have a relevant experience, one part which any of the competitive company can assess you on your performance, on your skill set, on your experience. Second is the skills that you acquire, and for that matter, let's say if you acquire some skills of risk valuation or research by doing a program, if you're an IPFT, so you acquire those skills, but then the projects will give you that practical exposure and experience how you implement those skills. All right, if you talk about, let's say, a research role, equity research role, I get a lot of opportunities from the company, from stockbroking firms, from BFSI industry, and I tell them that I don't have a relevant experience, but they are all trained on DSF model, the valuation, the risk model. They say, okay, ask them to prepare a a report, a financial report on any of the BSE or NSE listed company, show us. We want to see the format, their way of their writing, and we'll see how to evaluate or not. So this is something that we need to showcase, and this I also urge each and every one of you, wherever you go, whatever you do, to make sure you have this projects and internship and capstone project a major part of your learning process. Now, apart from this integrated mini project, I'll just reconfirm. I hope I am audible. Can anyone confirm? You can quickly ask them if they have any query regarding career placement. If not, we can wind this up. All right. So I think I have got this up from the host. Any questions on career services? Probably I think we should move on to that. Any questions on the career services? What are the kind of roles people have got landed into recently? Rohit, so we have placed our learners into as an institutional research, into debt restructuring, into a research analyst role, into business analyst role. These are the roles. Recently, we got a learner place who was from a mechanical engineering background, completely nothing related to finance. They did our course, and what we did is we also make him appeared in an NISM course, and we placed very recently him in a equity dealer role with a leading broking and securities company called SBI Securities. Package was very modest. It was about 4.5, but then we were happy that he got a start. He actually shifted his from mechanical engineering to a finance domain. And with time along getting those 6 months, 1 year of relevant experience, and with that skills getting, he can then, apart from then getting into a proper research role as well. So that's what focuses on, Rohit. Percentage wise, also what is the kind of percentage people have gone it? Percentage wise, as in the salary percentage, that industry standards are 30 to 40%. So we just got a learner place for as good as a 90%, but then that per learner was about at 4 or 5 and got around 9.5. So yes, that totally depends on how the interview goes. Generally, industry standards are between 30 to 40%. Merger and acquisitions, not yet. We didn't really had any profiles yet. We do get requirements, Rohit. As far as requirements are considered, we do get them in terms of either venture capitalist or investment relations, investment banking. It is the right skill set that we are looking for. How VC is valuing now across seats. Yeah. So this is my answer to your question, Rohit.
I guess that's all.
Okay. What
for
skills?
Today that
What
we have.
skills? Okay. I think there is one question with Kesava Rao. Skills.
Okay. You can take that, Mohit. You can take
Sure.
that.
I'll do that. So Kesava Rao, if I'm pronouncing it right, for what skills person must have to get, you need a number crunching. How do you prepare a research report? Your accounting, your research writing, your writing ability, understanding the company, the industry, the market, sentiments, and sector. These are the skills that you must have to have a equity research as a equity research analyst role, Kesava. And these are just primary roles I'm talking about for an associate role. And as and when you get experience and you get that relevant experience, you get to get a senior and a lead analyst role as well. I hope I was able to answer your question, Kesava. Can this course be equivalent to CFA level 1 with reference to knowledge important? Okay, well, to precise to this question, Rohit, I suggest you answer this. This will be I suggest let the faculty answer this question in tandem to what has been taught in CFA and what has been taught at FPR and IPFT. Probably you'll get a better answer. Me just telling you yes or no won't really make any sense. In fact, you can note down this question and you have IDs of, in fact, you can give your IDs as Rohit, and probably our learner consultant can get back to you in consultation with our faculties. Last question, let's wrap it up. Okay. Yeah, please. Difference in roles offered for fintech program and financial valuation. The major difference, Nisha, is in fintech program, there is also a technical aspect. If I talk about a major difference, a technical aspect is required. Probably in a fintech program, which we have also incorporated, considering the feedback that we've got, probably a use of Tableau or a Power BI or a bit of Python, a combination of these three, which can be taught, and at a very, very initial stage, even if you're a non-tech person, the only difference is this. analyst role, a business analyst role will help you out in a fintech program. A product manager role may help you out in a fintech program. Nisha. Those are the different role, major difference role. If I talk about the roles wherein there is a lot of data work is there, which requires knowledge of Python, Tableau, and Power. Okay, Nisha, I think I've answered the question. All right, I think Mahima, if there are no questions, we can end.
Thank you so much, Mohit, for taking all the questions. I think we have covered most of the questions here.
Sure.
In case if anybody still have any questions, I'll be just dropping down into the chat box our email ID, which is hello@herowired. You can write us in that email, and our learning consultant will be getting back to you with all your answers.
Absolutely.
Thank you so much, Mohit. Thank you so
Thank
much,
you.
Lalit, for such an engaging and this session. It was a wonderful session. Thank you so much, everyone, for being a lovely audience. We'll be getting back with you with another exciting webinar shortly. Thank you so much for joining, everyone.